Hey there everybody, welcome into this video. My name's Keaton Gilmer, if you've never seen one of my videos before, and I'm no genius, but I sure hope today I can show you something that you've never seen before. Also, I'm sorry if I look a bit rough, I just got off work. But today, in this video, I want to talk a little bit about what I've been thinking and hearing recently about the current state of our stock market, and just a little bit on how I will be moving forward, given everything that's currently happening. So, if you don't know me, I'm an optimistic investor with quite a long-term outlook for the companies that I love. And the media recently has been massively fear-mongering. It seems everywhere I turn, there's a new perspective or idea about the markets that is meant to intimidate me. And honestly, it's been working a bit. Every new data point I see makes me even more and more bearish. Even though the S&P 500 is down 25% and the NASDAQ's down 34%, I'm still getting more and more bearish. I've been trying to watch investors with way more experience than myself and see how they've been setting themselves up during this current market. And it seems there's a pretty big divide between the opinions of folks out there in the market. And some investors who invest way more money than myself have been doubling down on their investments, buying more and more. Or others have been holding back, either halting buying or selling all their positions, or even shorting, anticipating for the market to continue to fall. But personally, I believe too strongly in the companies that I own to sell them all. But the two ideas that I have been bouncing around my head are whether to increase my investing velocity or slow it down for the time being and wait for the economy and really the world to make just a little bit more progress towards becoming healthier, a little bit more progress towards a correction. Although I do want to give a little bit of perspective about myself before I start. Now, personally, I only have a limited amount of disposable income that I can invest, and I must be really strategic with that cash, deciding if I should save it away for potential future investments or add to my current exposure to the markets. Now, I've been investing very heavily over the past 9 months, probably around half of my income, and right now, there are a massive amount of economic issues in the United States and really abroad as well. And that's not even to mention the enormous amount of geopolitical turmoil that the world's experiencing. But let's jump into some of these interesting things that I've been hearing that are making me more so bearish than normally I have been. So the real estate market has yet to dramatically crash. Apple, Microsoft, and Tesla have been holding up the stock market, making this crash look honestly not as bad as it realistically has been for a lot of companies out there. And personally, I believe all of it must fall in order for our economy to really make a full recovery and for us to get to a healthier place. The Federal Reserve is showing no signs of a shift from raising rates to lowering them anytime soon. And at least as long as the unemployment rate stays fairly low, I don't see a shift like that coming anytime soon. And since unemployment is so low, a potential wage price spiral could occur, which is just as companies pay employees more, they must raise the price of their product or service, which ends up increasing inflation, which then creates a spiral effect. But at the end of the day, it's bad for the economy and it's bad for long-term company earnings. There is usually a lag of 6 to 12 months before the economy shows the effects of the Fed's interest rate changes. And the first interest rate hike happened 7 months ago. So we're just now getting into that time period. If you don't know, the rate hikes being done by the Fed are used to slow the spending of citizens by making borrowing money more expensive and therefore slowing the exchange of money between people. And this in turn slows inflation. It's a bit complicated, but I will move on. In addition to raising rates, the Fed is also shrinking their balance sheet, which means they're going to be selling mortgage-backed securities, corporate debt, and taking money out of rotation when loans are paid back, which will inevitably add to the downward pressure on the markets. The government refuses to call this a recession, even though by technical definition, it previously would have been considered one. The metrics used to calculate the CPI, the Consumer Price Index, or what we use to measure the inflation rate, have changed from what historically has been used, meaning that the displayed inflation rate people are considering and taking into account and for their investing decisions might not realistically be the best reflection of what's actually going on in the broader economy. The current CPI is around 8%, while if the historical metrics were used for our current time period, they would show a CPI of around 15%, which is quite a dramatic difference. But even if we do use this 8% number and we go based off that, that's still 4 times higher than the standard inflation rate. And at the end of the day, since treasury yields are increasing, the PE ratios companies have been able to command over the past 10 years or so are likely to fall a lot due to lower demand and the inherent higher risk of securities. Although this does just mean better discounts for long-term investors. Now, these are all real issues and they may have prolonged effects on the economy. Personally, with the velocity of the Fed's actions, I do believe as long as they don't lag with slowing their economic tightening as they did with starting it, the majority of these issues could be well handled within the next 12 to 24 months. Although, keep in mind, the stock market does usually tend to price in economic performance 6 to 9 months ahead of time, barring any dramatic curveball. But let us get on to a bit of good. So companies have already fallen to valuations I honestly never thought I'd be able to see. Forward PE ratios for small and mid-cap companies are lower than personally I've ever seen them and are at levels historically when they've reached, they don't tend to stay there very long. Large caps have finally started to reach valuations that seem reasonable, if not a tad undervalued. Granted, each could continue to fall, although smaller market cap companies tend to come back much quicker than the broader markets. Take Amazon during the 2000 tech bubble. It ended up bottoming around September of 2001, while the S&P 500 ended up bottoming around September of 2002, over a year later. Historically, November and December are very good months for the stock market due to the Christmas time rallies. The midterm election years are often fairly good years for the market, and investors have already priced in an enormous amount of bad news into company valuations. But I believe if the inflation rate continues to come down and these upcoming Q3 earnings are just good enough to beat the miserable expectations that are being placed on companies due to the current economic environment, stock prices could perform well. Although the issue here being, if the markets do rally, commodity prices will likely follow suit, which will cause inflation to appear even worse and will cause the Federal Reserve to make even more dramatic tightening decisions. Although the more I research and find this very important data, the more I realize the short-term outcome of the market is quite unknowable at this point, since more information is needed and more actions must be taken by folks that I have no control over. I've heard many lately saying buying the dip is not a good idea, but just look historically and make that decision for yourself. Lastly, I want to show you a short clip of Warren Buffett that I think really hits this last point home.
Well, I would say that at any given point in history, including when stocks were their cheapest, you could find an equally impressive number of negative factors. I mean, you could have sat down in 1974 when stocks were screaming bargains, and you could have written down all kinds of things that would have caused you to say, you know, the future is just going to be terrible. And similarly, at the top, you know, or any time you can write down a large list of things that would be quite on the bullish side. We really don't pay any attention to that sort of thing. I mean, we have, you might say that our underlying premise, and I think it's a pretty sound underlying premise, is that this country will do very well, and in particular it will do well for business. Business has done very well. You know, the Dow went from 66 to 10,000 plus in the 100 years of the 20th century, and we had 2 world wars and nuclear bombs and flu epidemics, and you name it, Cold War. There are always problems in the future. There are always opportunities in the future, and in this country the opportunities have won out over the problems over time, and I think they will continue to do so absent weapons of mass destruction, which is another question, and business won't make much difference if anything really drastic happens along that line. So I can't remember any discussions Charlie and I have had ever going back to 1959 that where we would have come to the conclusion at the end of them that we would have passed on a great business opportunity, a business to buy because of external conditions, nor did we ever buy anything that we thought was mediocre simply because we thought that the world was going to be wonderful. It won't be the American economy, in my view, that does in investors over a 5 or 10 or 20-year period. It will be the investors themselves. If you look at the record of the 20th century, you'd say, how can anybody have missed, in owning equities during that time? And yet, we had all kinds of people wiped out, in the 29-32 period. We had all kinds of things that were bad. But if you would just own stocks right straight through, didn't leverage them, you'd have gotten a perfectly decent return. So we're unaffected, in essence, by the variables you mentioned. Just show us a good business tomorrow and we'll jump at the hook.
So personally, even though I believe it's very well possible that the markets jump a bit soon, I'm still betting in the short term that the markets will be pretty rough. So hopefully inflation will go down sooner rather than later, and the economy can reach a much healthier place than it's been sitting at over the past couple of years. But companies are at exciting valuations when considering their long-term prospects. And personally, I believe the higher growth, higher risk companies that have been hit the hardest and fastest during this market downturn will be the ones that rise the highest and the quickest. Yet, they must survive. And keep in mind, the more companies that don't survive, the better place the economy will be in, because the ones that do survive are likely going to be the healthiest, best performing, strongest companies. And that's what we want our market full of. The safer companies too have been hit massively at this point. Personally, I'm thinking of Meta and Google, which at these prices I'm in love with. Given all that I've shown you and all that I've considered, I believe the best strategy, for at least for myself moving forward, is to continue DCAing into the market, or dollar cost averaging, on my favorite positions, and hope that prices continue to go lower and lower. Granted, while I will be doing that, I'm going to be making sure that I'm investing my money in diversified companies and in diversified industries, so that my money is spread out over the economy, not just in one specific area. Now, I will say, if you do not have a consistent stream of disposable income after all your expenses have been paid, I appreciate your view and I really hope you like this video. But before you start going and investing in the market, I would highly recommend that you get your income straightened out first, because I wouldn't be investing with money that I need to buy food with or I need to pay rent with. But if you are unsure if you're ready to start investing or not, please go check out some of my other videos where I discuss how to be confidently conservative with your investment decisions. Now, I hope that'll help, but for the rest of yous out there, I do believe one of the only things that I'm not considering, or I'm leaving out in this video, is if there were to be another world war, or some of this geopolitical drama heightens even further, causing ripples throughout the entire world even more. That is something that I haven't fully taken into account. And if that were to happen, potentially my decision to continue investing the way that I have been could be halted. But if you think there is anything else that I'm missing that could waver my conviction in my decision to keep investing in stocks, please leave it down in the comments and I'll see you down there. But until then, have a great day, and remember to make up your own mind when choosing an investment decision. You have to be the maker of your own fate.